This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Craig Martin, founder and president at the Family Wealth Consulting Group. The Family Wealth Consulting Group is a family-owned and operated fee-only financial planning firm that has been a fiduciary with clients in Silicon Valley, California for over 35 years. This family-centric team focuses on helping families maximize financial resources for today as well as for generations to come. Craig, thank you for joining us.
Glad to be here. I'm anxious to do this, and congratulations on what you're doing.
Well, thank you. So tell us about your background before working with early stage companies. What did you do before this one?
My goodness. So I have been financial planner in Silicon Valley for decades. And some 15 years ago, a client dragged me to an angel investment meeting with Keiretsu Forum. Mm-hmm. Keiretsu Forum is now the largest angel investment group in the world. And since that original meeting, I was intrigued with what they were talking about and joined as a member every year since then. And I've performed dozens and dozens and dozens of due diligence reports with other members. So we build a team of members and produce a report on an investment opportunity. Began to build that into an offer for my clients, talking about what I was doing, and clients were interested. So we began to co-invest with clients. And I put together a fund in 2010 to manage these investments because in 2010, the SEC told us that we had custody of all of those investments, which was an accounting legal nightmare. So we put together a fund and do those angel investments inside that fund. We've added things since then. We do an immense amount of real estate also, as well as have a second alternative income fund.
Great. So what excites you right now?
Doing angel investing is a 10-year commitment. And during that time frame, I'm most involved, engaged with the CEO and helping business planning, sometimes financial planning. And the exciting part is watching that business grow and achieve milestones. We've got a company right now that we invested into 4 years ago at 52 cents a share and got warrants at the same time. They're going out for a third level of funding starting January at $2.50 a share, give or take. And that's a 5x return for us. And I can buy warrants back at 52 cents. So just got out of a meeting with a client, and they're most anxious to participate in buying those warrants also.
Great. You see a lot of startups and a lot of investors in your line there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Join an angel investment group, in a lot of due diligence for 1 year before you write your first check, because it's that due diligence. It's sitting with other angel investors and watching them make decisions, as well as participating in the due diligence that will greatly enhance your skill at determining what you want to invest into. The risk you suffer in an angel investment, of course, is business, what we call business risk. That means the business could go to zero value. So that's true in the public traded stock market. And most people are saying somewhere between 15 and 20 stocks is how many you need to buy to eliminate business risk. Same is true in angel investing, but the number goes up significantly because the failure rate's much higher in startup businesses. So you need to be willing to commit somewhere between 30 and 50 different companies to build a diversified portfolio and eliminate business risk.
Great. Then on the other side of that table, what's your advice for people raising funding? What do you tell that founder to do before they go out to raise funding from your investors?
You need to build a solid business plan that you can explain and understand in detail. That includes financial projections. How you get funding can be either through angel investors who like to invest at the seed level before you have revenue, maybe before you have a product, and they're willing to fund the first milestone. So you want to decide how much money it's going to take to achieve your first milestone, say build your product. And once you've done that, you can go back to the angels and get second and third level of funding. Another alternative for funding is to find one person who can write a check for the amount that you need to fund your milestones. And good news is that if you that one person, once you find that one person, it's much easier to get funding, but you're stuck with that one person. May or may not complement you or your business the way you want. VCs get an awful lot of press. All the talk about funding startup companies is in the press is about what venture capital funds are doing. It's my experience. We live in venture capital center, Silicon Valley. So my experience with VC funds is that they're not willing to write that check at seed level. They want the company to have revenue and can't afford to write a check for $50,000 to a seed startup. They want to write a check for $5 million. So finding funding for your startup company is hard work. Unless you find that one angel willing to write that big check, you're out talking to dozens and dozens and dozens of angel investors.
Great. Well, let's talk about the state of angel investing. How do you see the industry evolving from here? Where do you see it going?
Well, angel investing is the lifeblood of new business. It, of course, is how every business got started. And the importance of startup businesses is huge. I think small business employs 70% of the employees in America. So we read the press about big corp that shut down or moved into town and how many employees they gained or lost. But the truth be told, it's the thousands of small businesses out there that employ the majority of employees in America. And there's a huge body of knowledge around the internet and AI and digital programming that are changing the way existing business is being run. And so when I'm performing due diligence, it's exciting to find a disruptive business model that is doing something at half cost and can scale for the whole industry because they're using digital programs to do that.
Great. And what do you think is the biggest change we'll see in angel investing in, say, the next 1 to 2 years?
Oh, pricing has always been a bugaboo. 15 years ago, a company without revenue was valued somewhere between 1 and 1.5 million pre-money. Today, they're approaching $3 million pre-money. Companies just got an idea. Entrepreneur just has an idea on the back of a napkin, and suddenly the business is worth way too much. That $3 million is just really high. However, that number is rising in spite of my opinion. And with inflation, impending inflation, seems to me that number is going to jump up significantly in the next 2 years.
I agree. I think it's going to be jumping up as well. So let's talk about your investment thesis. What do you look for and what do you invest in for your angel investing deals?
Well, the humorous response is only the most successful. If we could, then we would, but we can't, so I don't. I'm a portfolio manager, financial planner, so diversification is your only safety. We've trademarked that term, by the way, and so I'm not trying to focus on any one industry. We've got some 30 different angel investments in our portfolio, and very few duplications. So I'm looking for an entrepreneur. I'm looking. We call it the jockey. If you've got a great jockey, they'll take the horse across the finish line. The best horse, in my example, that's the business model. The best horse doesn't cross the finish line, number one, without the best jockey. So start out finding the right person. And I do that in multiple interviews and deep due diligence. And then I'm looking for how well that jockey, that entrepreneur, has prepared their business plan to maximize the returns of investment for me as an investor. My goal is to make 100% return per year, 100% IRR on an angel investment. I need to think I can get that number because of the failure rate of small business.
And can you talk about one or two startups that you funded that fit that thesis?
Sure. We got about 10 years ago, a private equity company came at me with an investment which built makes the fake fish. I don't know the names anymore. When you have fake lobster salad, the fish that's used in that was what they were making. And there must have been 10 competitors. And they were not number one when we wrote our check. The original founder of the company retired, and we put in a new CEO. So the due diligence was on the original company, the pro formas, the cash flows, the manufacturing, the distribution, the delivery, the sales team, quite involved, quite extensive. And then we had to hire a new CEO. So that was a very involved process. In 4 years, we got a return of 6-1 on that investment. That was a winner. We've got a fair number of companies right now which are really on a J curve of growth. So Link2 is one we could talk about. Link2 is spelled linqto.com. They are their business purpose is to commoditize, make private equity easy. So they go out and find shareholders in non-publicly traded companies that are destined to have an immediate and imminent IPO, and get that shareholder to agree to sell their shares. That process needs to go through the board of directors also. The board, of course, has the first right of refusal. So with approval of the board, this shareholder can now sell their stock on Link2's platform. And the company, I own shares in the company. The CEO founder of that company is a friend through the Keiretsu membership. And Yeah, lots of story here. So we bought shares in at, I'm going to say 40 cents a share, original check 4 years ago. They're selling shares now on the Link2 platform for the Link2 Corporation at close to $3. And all of that growth has come in the past year and a half or less. We bought shares of Ripple. You may know Ripple as one of the currency digital, I'll call them a digital company. And they issued a digital currency, currency, and the SEC sued them. Coinbase and Ripple, a year and a half ago, were neck and neck in the price of the value of the company. And Coinbase was not sued. Ripple was. Price froze on Ripple, and Coinbase went public, if you remember, in January. One of my clients works there and some $70 million net worth today. So Ripple, we're able to buy at, a quarter of the valuation that it collected its last funding round at. And the SEC is likely to walk away from this suit. And when they do, Ripple's price will come up to match Coinbase. That's a real exciting investment.
That's great. Those are good examples there. Well, there's always a lot of challenges in this space. What do you see as the main challenge that startup space that you deal with in today's market?
Getting funded,
Okay.
then running the business. So funding easily can take 6 to 12 months. That's a lot of effort. And the issue for the founder is that they need to, as I said, talk to dozens of angel investors. The CEO thinks they're running their business, but in fact, they're out there getting funded and running their business after 5 o'clock at night when they can no longer talk to prospective angels.
Right.
That makes a 12, 15-hour day pretty easy. But then once they get funded, they got to run the business and hit the milestones and do what they promised they'd do with the money. That makes the CEO a very busy boy.
Absolutely. And so what are the challenges in this space for the investor? What do you see investors struggling with the most?
Oh, lack of knowledge, lack of experience, and not diversifying enough. So earlier I spoke about new angel investors. I recommended they join a group of angel investors. I joined Keiretsu Forum. I got my experience in volunteering for dozens and dozens of due diligence reports, sitting in on research meetings on each of the investment opportunities. That taught me an immense amount. In the past 7-8 years, I've been teaching due diligence to other angel investors as well as entrepreneurs. Engaged right now with a team from, we're doing due diligence classes virtually for angel investors in Brazil. New idea, and totally different culture. So in America, I can speak to your question was what would I recommend for the angel investors? And in America, it's getting diversified and getting experience. In Brazil, it's a different story. They have a different laws and different culture there. So we teach things a little differently to that group, interestingly enough.
Great. Well, you see a lot of sectors and applications, and you mentioned several on today's interview. If you had to pick one or two that you think are really good opportunities to pursue today, what would you call out?
Boy, that's a good question. Certainly, the internet and the computer has introduced a tool that can be very disruptive in most industries. And so if you can invest, if an angel investor can find somebody who's got that combination of skill, knowing how to operate the computer and adapt it to, apply it to an industry that they are very experienced in, that is a powerful combination. And a good number of my investments have that general description. But we've also got medical research. We've got a company that's taking live cancer samples out of the body and growing them in the lab and testing which chemotherapy works for those live tissues. Otherwise, the doctor is guessing which chemotherapy to use. And if the doctor is wrong, probably too late for the patient. In this case, we're able to personalize that chemotherapy treatment. That's doing both good for the community as well as good for our pocketbook because, again, they're on a J curve also. So prices of those shares have skyrocketed.
Mm-hmm. Well, great. Well, so in the last few minutes that we have here, what else should we cover that we haven't?
Investing as an angel investor is fun. I spoke about the commitment I make to staying engaged with the CEO after I write a check. I don't walk away from that investment. I'm participating as frequently as the CEO can or will allow. And being engaged like that keeps me current on everything that's going on with that company. That is very exciting for me. The difficulty in the industry is that most angel investors are apt to make one investment and then take a back seat, make no new investments, and wait for that investment to do something. I said it takes about 10 years for that company to reach an exit. So they're basically in the business long enough to write a check and then out. And that's a real mistake for the angel investor. They've set themselves up statistically to lose that investment.
Mm-hmm. I understand. Well, great. Well, appreciate your taking time to share that with us today. How best for investors to get back in touch with you?
I'm at Craig at fwcg.net. That's CRAIG at Family Wealth, stands for Family Wealth Consulting Group, fwcg.net.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.